we go again. You might don't know, but we have a Hungarian channel as well. Not only the channel, I mean the YouTube channel, but we have the website and we have, of course, subscription packages. And there is a lot of people following us on the Hungarian channel. In fact, the Hungarian YouTube channel has more than 10,000 subscribers. I know. International-wise, this is not a big number, but in Hungary, it is actually. So in the last couple of 2 to 3 weeks, we received a lot of questions about how the 2-year yield and the 10-year yield is related to the stock market. And I would like to make you an explanation how this could be related, and hopefully it will be very useful to you. And also we're going to check out the next week macro data as well. So let's start at the beginning, and I'm going to share with you a chart. This chart is actually, before I start into this, excuse me, this is the first chart we need to take a look. On the left, you can see the 2-year yield, and on the right, you can see the 10-year yield. Now, the relationship between the bond yields and the stock market is coming from this two particular yield. And let me explain how. The relationship between bond yields, especially the 10 and the 2-year US government bond yields and the stock market is complex, but not impossible to understand. In fact, it can be simplified. If these yields continue to rise while the Fed maintains its monetary tightening policy, several effects could ripple into the stock market. The reason we anticipate further Fed interest rate hikes is the potential rise of inflation, which you might remember I made a couple of videos a few weeks ago in detail about how the energy prices are potentially affecting the inflation itself. So here is a few points that we have to keep in focus about that topic. The first is steepening yield curve. If the 10-year yield rises faster than the 2-year yield, the yield curve, which represents the yields of bonds of different maturities, starts to steepen. Historically, a steeper yield curve could signify economic expansion. On the contrary, if the 2-year yield rises faster than the 10-year, it can lead to an inverted yield curve, one of the early signs of recession. Now let me explain to you in a chart like this. This is the T10Y2Y chart on the trading view, which represents the yield curve between the 10 and the 2-year yield. A declining yield curve, according to the explanation I just gave you, can be healthy up to a certain point, but beyond the threshold, it creates a financial environment conducive to a recession. And the reason why, because every time the yield curve is arriving to a very low point, in case if the economy and the financial situation is not too good, this is the perfect environment for creating the recession itself. When this tipping point is reached and sustained over time, economic damage becomes evident. Thus, the Fed might switch from tightening policy to a more accommodative monetary policy in the interest of saving the economy. This is the Fed pivot. But remember, we are talking about saving the economy and not the stock market. And this procedure takes time for its effect to be felt. Now, if this situation occurs, there is a couple of points we need to focus on. First is increased borrowing costs. Higher bond yields mean the government pays more borrowing. This spills over into a broader economy, raising interest rates on everything from mortgages to business loans. This can slow sectors like real estate and capital-intensive businesses. The other one is the stock valuation. So generally, as bond yields rise, the discount rate used in stock valuation models also increases. This makes the future earnings of companies less valuable in today's terms. This puts downward pressure on stock prices, especially in interest rate-sensitive companies. And here's another one, pressure on growth stocks. Take tech companies and their stocks as an example. This is actually a perfect example because these stocks are currently driving the market gains, or it did in the last 3 months. The market does not price these stocks based on the company's current performance, but on its projected future performance. This can be manipulated as seen with companies like Nvidia. Therefore, companies, especially in the tech sector, that rely heavily on future growth expectations might find their valuation significantly impacted by the rising interest rates. This is because their valuation often rests on projected future revenues, and higher discount rates can diminish the present value of these future revenues. There are two issues for the stock market at this point. One is the rising bond yield, which shades the expected performance value of tech stocks. And the second is the inverted yield curve, especially after the tipping point. These will lead to a few consequences. First of all, a financial sector strain. Rising short-term interest rates, especially if they rise faster than long-term rates, can squeeze banks' net interest margins. If banks are under strain, it signals a challenge in garnering profits from their traditional short borrowing, long lending model. This is precisely the phase we are in now. On one hand, it suggests that the Fed pivot might not be too far away, but circumstances still necessitate further base rate hikes. Then here is the capital flight. So if US bond yields offer attractive returns compared to the global alternatives, they might attract foreign capital. This could strengthen the US dollar, potentially putting pressure on the stock market. And then distinct consumer behavior, which is very interesting. If consumers expect interest rates to keep rising, they might expedite big-ticket purchases, leading to a short-term growth in certain sectors. And we have observed this in the past 3 months. In the medium to long run, however, high interest rates could curb consumer spending, especially as financial institutions tighten terms, particularly lending terms. We are currently entering this phase. And finally, reinflation concerns. This concern is founded. As many may recall from the previous videos, there is a significant relationship between the inflation and energy prices. So there is a huge fear of reinflation and bond yields might continue to rise. This indicates that the bond market players expect the Fed's measures to be insufficient to curb inflation. This sentiment could further encourage risk-averse behavior in the stock market, making the race for risk-free options challenging, as these opportunities have vanished from the market nowadays. So with all that information, let me share with you another chart on top of this chart, which is the SPX. So anytime if we are entering this tipping point and we get a signal or recession by the yield curve, which basically happened 3 times when 3 major Fed pivots happened in a financial and economic crisis. This was in 1989, and then 2001, and then 2007. So every single time when this happened, the bond market technically exploded, and the money flowed out from the stock market into the bond market. And that is when the Fed pivot happened. So the major drop in stocks happened only when the Fed pivot happened. Sometimes it just started a little bit earlier. So we are in a situation right now when the yield curve is very low, and we are just waiting for the moment for the yield curve start to rise again, and the Fed is coming in with a pivot. And probably this will be the point when we could potentially see the biggest drop on the stock market. So whatever we got so far, it wasn't big enough just yet, according to the history. And now let's see macro details. So we are going to starting on Monday, which is a very easy day. There is only one data I would mentioning. By the way, all the time what you see on the screen is in Central European time. So at around 1 o'clock, there is a Rightmove HPI data coming out from the United Kingdom, which is the house price index from one of the largest housing agency. And this is a very important data because with that data, we can monitor the mid-class and the actual healthiness of the mid-class. And then we are going to Tuesday. This will be a little bit more. So in the morning, Bank of Japan core CPI, and then the BRICS summit is starting on this day for the all day. That's going to be very important. And then 2 more data from the United States. One is the existing home sales and the other one is the Richmond Manufacturing Index. Both of them very important at the afternoon. Now we're going to Wednesday, but Wednesday is going to be a little bit bloody. So there are manufacturing and services PMI all over the place. So first, the French and the German is going to report manufacturing and services PMI, the 2 largest economy within the European Union. And then we're going to get a combined European Union flash manufacturing and services PMI. Then the BRICS summit continues on all day, while the UK will report its own manufacturing and services flash PMI. Then we're going to move to Canada, core retail sales and retail sales, and then the United States is going to report the flash manufacturing and services PMI. And at the afternoon, there is one more data, the new home sales, which is also a very important data to check and monitor the mid class in the United States. So we're going to follow that very closely on the Pro server. And then coming Thursday, BRICS summit again, and then US unemployment claims, US core durable goods orders and durable goods orders, which is really important because we need to monitor how, for example, the car industry is expected to do in the next quarter. And this is something we're going to talk about it. And then Jackson Hole Symposium. I don't have to mention why it's so important. We are waiting for Jeremy Powell and all the comments he is going to share with us. And then Friday, of course, Jackson Hole Symposium is going to continue, but meanwhile, we're going to get a Tokyo Core CPI from Japan at 1:30 a.m. And then at the afternoon, a consumer sentiment, the revised consumer sentiment is coming from the United States. So, pretty busy week. Whoever is short-term trader is going to be very, very busy and very happy because there will be volume, I can guarantee that. So I wish you a very good success for the next week. If you have any question, visit our website, subscribe for the Pro membership, and you can enter our Discord server and asking any question, whatever you want. Until then, if you like this video, please give us a thumbs up and subscribe if you don't want to miss the next video. See you later.